So you've done it. You've been disciplined, you've saved up a nice pile of cash. First of all, congratulations. That's a huge step. But now you're kind of standing at a crossroads, right? You're facing a question that can feel, well, pretty paralyzing. What's next? This question, pulled straight from a Reddit forum, just cuts right to the heart of it all. And trust me, thousands of people are asking themselves this exact same thing every single day. So, in this explainer, we're going to break down a really simple but powerful framework from investment giant Vanguard that'll help you find the answer that's right for you. Let's dive in. Okay, first things first, we have to tackle a huge misconception. This idea that stashing your money in cash is the ultimate safe move. I mean, it feels secure, doesn't it? You can see it, it's there, but there's a hidden cost, a silent thief that's quietly eating away at the value of your savings.
So I'm going to ask you directly, is that money you've got parked in your savings account really as safe as you think it is? Well, the answer might actually surprise you.
And the culprit is this one powerful, relentless force: inflation. The best way to think about it is like a slow, invisible leak in the value of your money. That $100 you have today, it's just not going to buy you the same amount of groceries or gas or whatever next year. Your purchasing power is constantly, quietly shrinking. This slide shows the problem so perfectly. See, based on decades of Vanguard data, that first bar, the nominal return, that's the interest your cash earns. It looks okay, right? It's positive. But then look at that second bar. That's your real return after you factor in inflation. And poof, all that growth, it's almost completely gone.
Just let that sink in for a minute. 4 times. That means for 16 of the last 20 years, your safe money was actually losing value. It was buying you less and less each year.
And here's the long-term picture. Over more than 60 years, the real return on cash has been less than 1%. It's barely keeping its head above water against inflation, which makes it incredibly difficult, if not impossible, to actually build long-term wealth.
So if holding cash is basically a losing game in the long run, what's the alternative? Well, it's investing. And this brings us to the fundamental trade-off in all of finance, this dance between risk, reward, and maybe the most important ingredient of all, time. Wow. Okay, this table shows you the sheer power of that trade-off. Just look at what happened to 10,000 pounds put into cash versus the stock market. Now check out 2008, right in the middle of the financial crisis. The cash was winning, but then, fast forward to today, it is not even a contest. The invested money is worth over 4 times more. That's the power of time.
That result is just incredible, isn't it? But it's not magic. It really begs the question, what is the engine that's driving such a massive difference over the long run? The answer is a really key concept called the risk premium. Put simply, it just means that investors are rewarded for being willing to take on the calculated ups and downs of assets like stocks. That extra potential return you get, that's your compensation for taking a risk. It's the fuel for long-term growth.
And here's what that risk premium looks like in a picture. Look at cash all the way on the left, super predictable, but a very low return. Now, as you move to the right, to bonds and then to equities or stocks, the potential for higher returns grows a whole lot. But what's the trade-off? Well, that range of possible outcomes gets much, much wider. You're swapping certainty for a higher chance at real growth. Okay, so we've established that cash gets slowly eaten by inflation and that investing offers higher potential rewards, but with more bumps in the road. So how in the world do you choose? Well, this is where the framework comes in. Think of it like your own personal map for this decision, built around you and your unique situation. And your decision really comes down to 3 core pillars: how you feel about risk, or your risk tolerance, how much time you have, which is your time horizon, and how close you are to your goal or your funding level. First up, risk tolerance. This is super personal. It's all about your gut feeling. Do you lose sleep when the market dips? Do you prioritize just keeping what you have safe? That makes you more of a conservative investor. Or are you okay with riding out some storms for a shot at better growth down the line? That's more aggressive. And look, there is no wrong answer here. It's just about being honest and knowing yourself. Now, the second pillar is your time horizon. And this chart shows exactly why it is so critical. In any single year, the stock market can be a total roller coaster. I mean, look at that huge range of possible outcomes. For a short-term goal, that is a massive amount of uncertainty to take on. But look what happens when you stretch that time frame out over 10 years. That wild range of returns, it narrows dramatically, and it becomes almost entirely positive. Time has this amazing way of smoothing out the volatility, which makes it much more likely you'll actually get to capture that risk premium we talked about. And the final pillar is your funding level.
This one's pretty simple. If your goal is to save $20,000 and you've already got $19,000 saved up, you don't need to swing for the fences with a risky investment. The closer you are to your goal, the more you should focus on just protecting what you've already built.
All right, so that's the framework. Now let's put it to work. Let's see how it applies to two very different people with two totally different goals. This is where the theory gets real.
Okay, so let's meet Dana and Johan. Dana is saving up for a down payment on a house that she wants to buy in just 18 months. Johan, on the other hand, he's saving for retirement, which is more than a decade away. As you can see, their situations are pretty much worlds apart.
So when we apply the framework to Dana, what do we see? Her time horizon is super short. Her risk tolerance is low. She really can't afford a big loss. And she's already close to her goal. For her, the number one priority is preserving that capital. A big market drop could completely derail her dream of buying that home. So for Dana, holding cash is absolutely the smart, logical choice.
Now let's look at Johan. It's a totally different story. His time horizon is long, which gives him plenty of time to recover from any market downturns. He's comfortable with that volatility, and he's still a long way from his final retirement number. For him, the biggest risk isn't a market dip, it's inflation silently destroying his savings over the next decade. For him, investing is absolutely crucial to have a real shot at reaching his goal.
And this brings us to what might be the most important point of all. It's time to completely reframe how we think about risk. You see, the goal isn't to find a path that has zero risk, because guess what? That path just doesn't exist.
This quote from Vanguard just sums it all up perfectly. Stocks are risky, and so is avoiding them. Yes, investing in stocks is risky, but as we've just seen, playing it safe in cash carries its own risk, the near certainty that inflation will chip away at your savings and put your long-term goals in jeopardy.
So the question you should be asking yourself isn't, how do I avoid risk? The real question is, which risk is the right one for me to take? Is it the short-term uncertainty of the market? Or is it the long-term grinding certainty of inflation? By using this framework, your risk tolerance, your time horizon, and your funding level, you now have the tools to answer that question for yourself.